We just finished going through Ciena's fiscal 2026 second quarter earnings call materials, and now we want to share our takeaways with you. Look, everybody's chasing AI names these days, but how many of them are actually printing real hard money? Here's one that is. Revenue ripped 40% higher, earnings nearly quadrupled, and orders are pouring in faster than they can build. Demand isn't the problem anymore. The real question is whether they can supply it. Stick around, because this one is genuinely worth your time. Let's start with the headline. The company reported second quarter revenue of $1.57 billion, up 4% year over year. And that wasn't just strong, the filing shows revenue came in $71 million above their own guidance. Adjusted earnings per share landed at $1.64, which the company says is roughly 4 times what they earned a year ago. 4 times in a single year. That's not a rebound. That's a different company than the one you remember. Here's the line that matters most. The company stated equipment gets shipped the very moment it is built. Think about that. This isn't a business begging for orders. It's one that physically cannot build fast enough. Our take is the entire investment question has flipped on its head. It's no longer about when demand recovers. Now, the only questions that matter are whether supply can catch up and how far these margins can stretch. Let me make Ciena's business dead simple, because once you get this, the whole story clicks into place. Picture the data centers as giant factories full of GPUs. All that compute is the engine doing the heavy work. But the data has to move between those factories, and that movement is the highway. That's what Ciena actually sells. The company puts it bluntly, networking must move to the compute, so wherever a GPU cluster gets built, fiber has to follow. And it has to haul massive amounts of data, fast at low latency and low power. Here's the beautiful part. Our red is Ciena doesn't have to bet on which chip wins the rack. The company stated it wins regardless of which GPU dominates, because every one of them still needs the road underneath it. I'm telling you, selling the toll road beats mining the gold. You collect no matter who strikes it rich. So you might ask, if this toll road is so good, why doesn't everyone just pile in and compete it away? Great question, and the company lays out the answer as 4 pillars stacked right on top of each other. Systems at the base, then interconnect, then software, and sitting on top, global operations running 24/7 around the clock. Most competitors assume the moat is the hardware, the components, but the filing says that is exactly the wrong read. The real barrier is assembling all of it into one end-to-end system that spans thousands of kilometers and still pencils out economically. Wrap that in control software and a worldwide service operation, and you've got something a pure component shop simply cannot copy. The company calls it a decades-long capability gap, and our take is that phrase is carrying a lot of weight. Generic component makers keep trying to climb up into systems, and they keep tumbling off the cliff. That right there is the moat. So why is all of this happening right now? Why this quarter and not 3 years ago? The company points to 2 demand engines, and here's the key thing, they're both roaring at the same time. Engine 1, the hyperscalers, the filing shows upward revisions to their 2026 and later capital spending plans, and they're deliberately steering a heavier slice of that money toward network gear to unlock the compute value that's sitting there trapped. Engine 2 is the one people forget. The service providers are finally back, reinvesting in fiber after years lost to 5G. The company's stated service provider revenue grew 28% year over year, with India's managed fiber deployments doubling. Put the two together and the company says the addressable market roughly doubles to a projected $50 billion by 2029. 2 engines firing at once. After years of one or neither orders packed this full, is demand going to be weak? I don't think so. Revenue's only half the story. What we really want to know is whether the profit underneath it is real. The company reported adjusted gross margin of 44.9%, up a full 400 basis points from a year ago. 4 percentage points. Yeah, in an equipment business, margin climbing like that is not a small thing. The filing shows that beat their own guidance by 90 basis points, with adjusted operating margin sitting at 19.5%. Now look at the cash. Free cash flow came in at $219 million, about 13.9% of revenue. And the company stated the cash conversion cycle shortened by 20 days, meaning they're turning work into actual money faster. They're sitting on $1.4 billion in cash, and they still bought back $83 million in stock at an average price of $371. Here's the tell. The company has raised its gross margin outlook in all 3 guidance updates this fiscal year. When a company keeps raising the bar on itself, our take is the hand they're holding is better than the one they're showing. So where did that 40% actually come from? Let's pop the hood and break it into 3 pieces. Piece 1 optical networks grew 42%, and the company says that was driven by the RLS and wave server lines, both up over 55%. Piece 2 is the eye opener, routing and switching ripped 88%, fueled heavily by adoption of something called DSOM. That's their data center out of band management. Just keep that name in your back pocket. It comes back later. Piece 3, cloud direct revenue jumped 70%, and here's the part to notice carefully. The company stated just 2 major cloud clients now make up roughly a third of total Ciena revenue. Now somebody always asks, didn't a big telco customer drop out of that top tier? What happened there? Our rate is nothing bad happened. It's just math. The hyperscalers grew so fast, they diluted everyone else's share. The point isn't who fell off the list. It's that all 3 cylinders are firing together, and that's what puts the horsepower on the board. Alright, this is the page I want you to really sit with, because it's where a lot of folks get scared off. The company reported total backlog of $7.7 billion, a mountain of orders waiting to be filled. And I know what some veterans are thinking. We've seen this movie before. It's a COVID setup, orders pile up then evaporate. I'm telling you, this time the plot is different, and the company spells out exactly why. Back in the COVID era, gear shipped out and piled up in warehouses, then came the delays and the cancellations. This time, the company stated equipment goes into the ground, not the warehouse. It's getting deployed, not stockpiled. They say there are 0 signs of inventory buildup or cancellations, and customers are actually pushing for faster delivery. Why the rush? Because the company says deployed gear turns directly into revenue for the customer's own compute clusters. Of that $7.7 billion, the filing shows hardware backlog around $6.4 billion, with 80% slated to ship inside 12 months. That's real deployed in the ground demand. Our take is this is backlog being throttled by supply, not a phantom built on fear. Margins look gorgeous, but after 20 years of reading the tape, I always ask the same thing. How exactly did they get there? The company says that 44.9% gross margin came from 3 levers: engineering, cost reduction, product mix shift, and optimization. Sounds great, but here's the wrinkle, and you need to hear it, because it's the whole sustainability question. An analyst asked them point blank, can you just raise prices on that existing backlog? And watch how they answered. The company sidestepped it. The filing shows they kept pointing to value exchange, supply risk sharing, and payment terms, not actual price hikes. Did you catch that signal? They didn't say yes and they didn't say no, they changed the subject. So our read is this: the margin expansion right now leans on engineering outrunning inflation, not on real pricing power. And that matters because cost downs have a flaw. The day inflation outruns the engineers, the margin story gets a lot harder. This is the line we'll be watching every single quarter, because it's where the whole bull case quietly lives or dies. Now let's talk about the big future weapon. It's called Hyper-Rail. Think of it as a multi-rail version of their line system. This quarter brought a real headline. The company announced an industry-first multi-rail order from a leading hyperscaler. The company stated that deal is worth hundreds of millions of dollars, spread across multiple years. And here's the kicker. The company says adoption is running a little ahead of what they originally expected. What makes it special? The filing says it solves the physics of high-intensity AI training over long distances, running data across multiple fiber pairs at once. But hold your horses. Let me be straight about the timing, because this is where people get ahead of themselves. The company stated the revenue impact this year is 0. The product launches later in 2026. Nothing booked yet. The real ramp comes in 2027 and beyond, and the company expects it to be a linear scale up, not a sudden flood. That scale up is expected to trigger a structural step function jump in gross margins. So our take is simple. This is the 2027 weapon, but the trigger isn't pulled yet, so we wait. The last page was about the long haul road. This page is a whole different fight. Ciena pushing right inside the data center walls. Lead character is DCOM, that data center out of band management I told you to keep in your pocket. Here it comes back. The company estimates that market at $1 to $3 billion by 2029. Small today, but a brand new room to grow into. Where do the clients stand? The filing shows it's anchored by Meta, a second client already secured, and a third in lab validation. But DSOM is just one punch. The company is throwing a whole combination here, so stay with me. On the interconnect side, the company reported a major win for its high-performance coherent modules taken straight off a competitor. Pluggables landed their first big switch OEM integration using WaveLogic 5 and 6 nano, and the stated objective is to double pluggable revenue versus 2025. There's also a chip called Nitro from the Nubis side. The company says those linear drive modules move to general availability this summer. You see the pattern. Our take is Ciena is taking that system, level muscle, and marching it right down into the modules and components inside the rack. Okay, time for me to pour a little cold water, because every good story needs an honest gut check. Is this Moat truly impervious, or is part of it just a nice story? Let's split it into two battlefields. First, the fortress, that's wide area and metro. The company puts that market above $20 billion by 2029. Here Ciena's edge is decades of end-to-end integration, control software, global operations, and the filing calls it a chasm component upstarts keep failing to cross. On that side, I'll give them the check mark. That fortress looks impervious, and the company's earned that word. But the second battlefield, inside the data center, that's the frontier, and here the company flat out admits Ciena is the newcomer. The honest question, which the filing itself raises, is whether system-level engineering advantages actually translate into rack-level component share against entrenched incumbents. So our take is this: on home turf he's the king, but in that unfamiliar room the thesis is still pending validation. That's the open question, and it's exactly the kind of thing you answer with hard numbers, quarter after quarter, not with faith. Everything so far has been good news: demand roaring, orders stacked, backlog overflowing, but now I have to sound the alarm. The real ceiling on this business isn't demand at all, it's supply, and I'm telling you that distinction matters. Because no matter how full the order book gets, if they can't build it, none of it turns into revenue. So where's the pinch? The filing shows the first is modems and CDM, partially buffered by vertical integration but running at absolute limits. The second is nastier, pump lasers. The company calls it the critical constraint for amplifiers, requiring daily executive management. Read what that means. The company's stated revenue velocity is dictated by manufacturing intake and component availability, not by market appetite. Their fix is concrete. The company is injecting $250 to $275 million of capital expenditure, targeting long-term supplier commitments to widen the funnel. So from here on, our take is don't just watch the orders, watch the parts, because the filing warns any supply misstep immediately caps growth. Losing that pinch point, and the revenue rips. That's the whole game on this page. One more alert, and this one's subtle. So let me teach you how to listen for what isn't being said. We don't swallow the polished talk whole. We listen for the questions management quietly steps around. First, that pricing question again. The company kept answering with value exchange, supply risk sharing, and payment terms. The filing reads it as a direct evasion. They won't confirm outright price hikes on the backlog, so margin defense leans entirely on internal cost control. Second, somebody did the math on the guidance and saw fourth quarter margins softening, and management said don't overread it, wait for Q3. A read back by the filing is that's a tacit admission of downward pressure from product mix shifts and persistent inflation. Third, asked about 2027 operating leverage and the newbie's financial impact. The company flatly refused to quantify any of it. The filing's own words: that leaves the long-term model reliant on faith, and faith is not a number you can underwrite. None of this means the company's hiding something rotten. Our take is these are the soft spots, the things smart money verifies quarter by quarter. Where they dodge is usually where the win isn't locked in yet. So now let's string it all together and do the second order thinking, the part that separates a trade from a thesis. First, the distance multiplier. The company says 1,000 kilometers needs 4 to 5 times the photonics of a 100-kilometer link. So as AI forces data over longer distances, the gear Ciena sells per connection multiplies. That's a structural tailwind, not a one-off. Second, hyper rail scales in 2027, and the company expects that to lift higher margin systems as a share of revenue. Third, the supply pinch. Breakthroughs in pump laser and CDM capacity are now the primary catalysts for an upside earnings surprise. Stack those three and our take is clear. Ciena is a supply unlocked asset, not your plain vanilla demand growth story. And here's the punchline. Today the margin is cost driven. The engineers grinding costs down to outrun inflation. The day it flips to structure driven, selling structurally higher margin systems through hyper rail, the market's whole valuation lens on this name gets rewritten. That right there is the turn we're positioning for. Last page, and I'm turning all of this into a dashboard. 5 gauges, watch these every quarter and you'll never fly blind. 1. Backlog velocity. Can that 7.7 billion hold? And does the 80% of hardware actually convert to revenue inside 12 months? 2. Margin mechanics. Watch the tug of war between engineering cost, downs and inflation, and keep a close eye on the fourth quarter. 3. Hyper rail realization. After the second half launch, does multi-client adoption show up and lock in that 2027 linear scale up? 4. Data center infiltration. Watch whether that third hyperscaler converts from lab validation into real deployed desarm orders. 5. Supply unlocking. Judge the return on that 250 to 275 million capex spend. Is it actually breaking the pump laser bottleneck? I'm telling you, the day all 5 of these needles swing green together, that's when Ciena's sweet struggle turns into a clean, full win. Until then, we do what we always do. We check the numbers 1 quarter at a time, and we let them do the talking. If you like this kind of analysis, it's the kind that does not ride the market's mood and stays locked on industry data and hard logic, please subscribe to Value Stock Radar, hit the bell, like and share. Your support is what keeps us digging through the financials and hunting down quality names. This is Value Stock Radar. See you next time.